Oh, good afternoon, everyone. Welcome to the last Rhodes talk of the semester, which is not actually quite true. Today we're going to be talking about Leah's book, Our Money, Monetary Policy as If Democracy Matters. More about that in a moment. But first, a plug, because the actual last thing we'll be doing this semester is April 30th. It's the annual Ethics of Capitalism lecture. We do one special one every year. Usually we bring in people from outside, but this year we decided to keep it local. So Seth Rockman from the History Department, whose lovely new book, Plantation Goods, A Material History of American Slavery, is out. And I started to read it, and it's like, damn, Seth, you're a good writer. You don't expect that. Sometimes you pick up books and you're like, oh God, here we go. And you're suddenly like, oh my God, you can actually write. This is kind of really cool. It's great. So that's good. Anyway, so I'll be having a conversation with him about the book on April 30th. One other materially important thing. I hope you're enjoying the kebab and curry, because that's the last of it. Right, we're now under a budget. That's it, done, right? We're under the budgetary lockdown. I don't know if anyone, I'm sure everyone has seen the rumour of the precise punch in the face that we're about to get. So we'll see if that comes off. But one thing that's not going to be on the menu is more free curry. So next semester, none of this unfortunately happens. So we'll see what happens there. That's that. All right, so anyway, Leah. Leah was, even when you were at Harvard, you were effectively one of my PhDs, right? So, total insider nepotism here on this whole thing, exactly. And it's basically, I know this project well, and I've seen it through. It's great to see it as a book now. She's currently a postdoctoral researcher at St. John's in Cambridge, and the other Cambridge, not the one next to Boston, like the proper one, if you want to put it that way. And the book has just come out with Princeton, and she's going to talk about it. But basically, I think it's a really, really important book because it kind of taps into two things. In terms of the current moment, a lot of the sort of anger and dissatisfaction and volatility and doubt in government and all the rest of it that's going on is about the failure of technocracy to do what it says on the tin, right? So particularly with central banks, when you basically go through sort of the great moderation, we've got it all together, and then you have a 2008 whopping great crisis, and then you mishandle that, particularly in Europe, and you get a decade of zero growth and so on and so forth. And then you turn to green central bank, and it turns out, oh, that was a head fake. We were basically just doing that to greenwash ourselves. Then, you're not looking that good at this point in time. And what Leah points to in her work is that there's a real issue here, which is we infantilize legislatures by delegating the really important stuff to technocrats. And when you do that, you get a blowback effect if they can't manage it, and then you end up hollowing out democracy. And I think this is a really, really important insight. So with that, I'll ask her to come and give us a talk about it. Thank you.
All right. Thank you, Mark, for that. Mark has been hearing about this project for a really long time, so it's particularly gracious to get this invite to hear about it yet again. And thank you to all of you guys for coming. I'm really excited to be here talking about the book. Thank you in particular to Allie for sorting out the logistical details and getting me over the pond. So, as Mark said, today I'm going to talk about the book, Our Money, Monetary Policy as If Democracy Matters. And I've got sort of the list of chapters here. I'm not obviously going to get into all of that today. Instead, I'm really just going to focus on the sort of key observations in the book. And really, it's pretty well encapsulated by the subtitle, right? Monetary Policy as If Democracy Matters. Because really, the book is an exploration of the relationship between the power to create money or regulate money creation and democracy. And in essence, offers an argument against central bank independence, at least as currently constituted. So, excuse me, the top hits that I'm going to kind of offer for you guys today are these four observations, and this is going to provide kind of the structure for the talk, right? The first one is just the basic observation that monetary policy and democracy are fundamentally linked. Second, that the existing system, right, that we use to conduct monetary policy today, which I describe in the book as a form of guardrails and compliance, delegation by guardrails and compliance, what we often refer to as central bank independence, it's both democratically legitimate and properly accountable, but it still undermines the health of the democracy over time. By contrast, monetary policy that was, if it were designed to support the health of the democracy over time, would look something like what I describe in the book as iterative governance, right? So more active management of the central bank by the legislature. And then finally, I just end by this observing, right, that monetary policy, as if democracy matters, will have to be political monetary policy, right? And to conclude, I'll consider a few of the sort of core challenges to my view, or what you might describe as the kind of main arguments in favor of central bank independence today. Brief note before I get started on the jurisdiction, right? So I focus obviously in the book on the US and the Federal Reserve, but the theoretical insight, so the kind of political theory in the book really does travel. So you can apply it to other jurisdictions, and I'm happy to talk about those in the questions if anyone's interested. All right, so to get started, monetary policy and democracy are fundamentally linked, right? So money, of course, enables all of those people who have it, right? It permits us to allocate resources. We use it to buy and sell things, to move goods from here to there and back again. And in particular, in the form of credit, money helps us transform our lives, right? So we buy houses with it. We use it to go to law school or start a business. With credit, corporations invest in new factories, engage in research and development. States go to war, build infrastructure, etc. So credit is really the form of money that we use to create the future. Most discussions of democracy and money tend to focus on the ramifications of income and wealth inequality, right? So what are the consequences for society when some people can earn or simply have so much more money than others? In contrast, at the root of this book is really the motivating observation that the power to create money is bound up with the democratic project. So who gets to decide if, when, or on what terms we create money influences how we relate to one another and to the future. So to understand the balance of power over money creation in modern society, and in particularly in the US, both as it is now and as it would be in a democracy, we have to understand the institutional arrangements that determine who makes those choices. I want to note here that a real key to seeing this foundational connection, as I do, between monetary policy and democracy is the idea that time really matters, right? So on this view, democracy isn't just about distributional politics, right? Who gets what, when, and how. It's also about how we as a collection of equal citizens shape the future going forward, okay? So state powers, and in particular, monetary power, creating and allocating credit, are key to that, okay? As things stand today, in nearly all modern states, central banks are the entities that govern the creation of money. Central banks conduct monetary policy when they unilaterally create new money and when they incentivize the private financial institutions to create more or less money, right, by altering interest rates and regulations. Monetary policy in this way organizes, enables, and steers collective production. So Susan Lohman writes that, quote, monetary policy decisions affect the wealth and well-being of just about every member of a modern industrialized society. So it's how we regulate our collective economic activity over time. Monetary policy, then, is a foundational power of the state, and yet, in most modern democracies, it's wielded by independent, unelected experts and implemented primarily through private financial markets. Decisions about if, when, and on what basis to create money are intentionally insulated from democratic politics. Many believe that this thick insulation between the legislature and the central bank is very important, right, and necessary because monetary policy is either too complicated or too important to be left to politicians. Now, over the last 4 decades, this view has really become remarkably dominant, shaping the structure of democracies around the world. Good monetary policy here on this view requires the presence of expertise and the absence of politics. And the contemporary arrangement, of course, characterized perhaps most recognizably by central bank independence, is what I refer to in the book as a system of political delegation through guardrails and compliance. So central banks are, of course, only one piece of a vast administrative state, right, which is populated by unelected policymakers. The status of such administrators, particularly independent bodies like the central bank, has been a question for democratic theorists for a really long time. In a democracy, we tend to say political power, the power to determine the rules that people live by, travels along a chain of delegation, right? So from the people constituted as sovereign to their legislature, from the legislature to the administrative state, and then in some cases, on from the administrative state to private industry. This first moment of delegation from the people to the legislature is the topic of a huge amount of scholarly literature, right? From the titans of political theory like Hobbes and Rousseau, who consider in great detail the relationship between the sovereign and the government, to theorists of representative democracy, all the way to contemporary empirical political science on electoral structures, matters of gerrymandering, campaign finance law. The third moment of delegation has also received more attention recently, particularly as it pertains to monetary policy. So I'm thinking here of the growing literature on the role of private banks and now what some call shadow banks and Eurodollar banks in money creation, what some call the finance franchise, but it's also related to what others have dubbed the infrastructural power of finance, and includes, of course, this long-standing literature in political science on privatization and in economics on the efficiency of free markets. The focus of my book is the somewhat less discussed second moment of delegation from the legislature to the administrative state. And insofar as it is discussed, scholars have tended to focus on it through the lens of legitimacy. Is the unelected bureaucracy that in practice determines most of the rules that we as citizens live by a threat to democracy, right? Is it democratically legitimate? And most people tend to start looking at this problem through the basic worry, right? That if in a democracy, citizens are meant to guide policy, if it truly is government by the people, then democracy must be at odds, or at least in tension with, a monetary policymaking arrangement that explicitly and intentionally insulates policymakers from the influence of citizens or elected officials. Well, perhaps not, right? So many scholars have suggested that this is far too a simplistic understanding of democratic legitimacy. The question of if delegating policymaking powers to the administrative state is legitimate is not about if any delegation occurred at all, right? Because of course that view would suggest that pretty much all of the administrative state would be democratically illegitimate. But rather what matters on this view is the conditions for delegation. So for many, the delegation of policymaking powers from the legislature to the administrative state is legitimate if it meets certain criteria, okay? Some scholars emphasize substantive conditions, right? So only technical matters should be delegated, for instance. Others focus on procedural considerations, right? So the administrative agents need to reason in specific non-arbitrary ways, or they need to act as trustees or fiduciaries to the public good. And then there's still other scholars, of course, who focus on the outcomes of the delegation procedure, right? So was the policy a good one? Was it worth it? Together, these views constitute what I call a guardrails and compliance conception of delegation. So the legislature sets the guardrails for delegation, and then the policymakers need to be held to account, right, to ensure compliance with those conditions. Fed Chair Jerome Powell sums it up, I think, really well in this quote here, right? So with independence comes the responsibility to provide transparency that enables effective oversight by Congress, which in turn supports the Fed's democratic legitimacy. And this is, of course, exactly what we see at the Fed, right? Congress gave the Fed a mandate and at least arguably holds the Fed accountable to that mandate regularly in the form of the Fed Chair's testimony to Congress, among many other forms of accountability. So the Fed is, in other words, on my view, and on this view, democratically legitimate. And yet, something still doesn't seem quite right? So it's still the case that in the US, the Fed really calls the shots on monetary policy, not Congress. And that seems at odds with democracy considered as a form of self-government. In chapter 1 of the book, I describe the contemporary state of monetary policy in the US as a case of central bank dominance, right? So central bank dominance, as I describe it, emerges from this mutually reinforcing dynamic between epistemic authority and structural dominance of the modern central bank. And the consequence is that it's not Congress that holds the effective power over money creation, including the power. The Fed actually also has the power to shape what Congress sees as possible and at times explicitly opposes its policies. So thus, even if it's strictly true that the contemporary monetary policymaking regime is both democratically legitimate and properly accountable, it still doesn't seem quite right in this democratic context. And this brings us to the earlier observation I made about democracy sitting in time. right? So what we care about is not just distributional matters, who has what, right? But the capacity of the democratic public to act together to shape the future, then we need to think about more than legitimacy and accountability. Because legitimacy and accountability don't offer us resources for capturing that capacity. They're concerned primarily with if the central bank has acted in accord with existing guardrails, but not so much about who has the effective power to determine or change the guardrails themselves. So in short, legitimacy and accountability are really backward-looking criteria. And where in a healthy democracy, we also require some sort of capacity that is more forward-looking to shape monetary policy. So consider an example of central bank dominance in the form of the Fed's mandate, right? So this is the Federal Reserve's mandate as stated in the Federal Reserve Act, and it says the following: the Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production so as to promote effectively the goals of maximum employment, stable prices, and moderate long-term interest rates. So the mandate actually tasks the Fed with 3 goals: maximum employment, stable prices, and moderate long-term interest rates. But the Fed's aim is almost never understood as tripartite, right? Most frequently, it's referred to as the dual mandate: stable prices and maximum employment, ignoring this last aim, moderate long-term interest rates, as redundant. As the former Fed Governor Mishkin put it, right, quote, because long-term interest rates can remain low only in a stable macroeconomic environment, these goals are often referred to as the dual mandate. That is, the Federal Reserve seeks to promote the co-equal objectives of maximum employment and price stability. So the Fed chooses to ignore this last goal, moderate long-term interest rates, on the back of macroeconomic theory suggesting that it's redundant. Despite the common dual mandate rhetoric, the maximum employment aim is also arguably equally as redundant in practice. And as a result, in theory, the Fed's mandate is not actually dual, but in practice singular. As Chair Powell recently said, our responsibility to deliver price stability is unconditional. The redundancy of the maximum employment aim is put really starkly in this vignette, written by a former Board of Governors member who was recalling an encounter he had with the Federal Reserve Bank president. And it's really quite something, so I'm just going to read it in full. I asked the Federal Reserve Bank president how he thought the FOMC should try to achieve the congressionally stated goal of maximum employment. His response was that the best way to do that was by achieving price stability. I asked if he thought accordingly that the maximum employment aim was superfluous. He allowed it was. I then noted that in interpreting statutes, one usually presumes that the words or phrases inserted by Congress do have significance and shouldn't be effectively read out of the statute. His response was that Congress had gotten it wrong, so he would continue to regard the maximum employment part of the dual mandate as having no significance for Fed monetary policy decisions. Now, of course, not all members of the FOMC believe in the complete redundancy of the Fed's employment mandate. Some believe that maximum employment is not a redundant aim, but is still lexically inferior to price stability. So as Chair Powell recently explained at a Fed press conference, price stability is, quote, the bedrock of the economy. If you don't have price stability, the economy is really not going to work. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. This is just one small example of what it meant to demonstrate the vast degrees of freedom that the Fed operates with when acting within its mandate, and further how it stretches and interprets that mandate in ways that are seemingly not in line with, and even at times contrary to, the legislature's explicit aims. All of this is not even to mention what I go into detail in the book about, which is that since 2008, the Fed has possessed the power to pay interest on reserves, which effectively uncouples the Fed's efforts to pursue price stability and its balance sheet operations when it buys and sells assets, which leaves it with enormous money creation power that is, in essence, unguided by the mandate. So at an intuitive level, this central bank dominance, or what some call Fed autonomy, seems to be a problem for democracy. Under the contemporary system, it's the Fed, not Congress, that holds the effective power to determine if, when, and how we create money. So in sum, the contemporary approach, the problem with it, on my view, is that it's focused on ensuring compliance to legislative guardrails, and thus can be described as legitimate and accountable, but it fails to maintain the effective power of the legislature over the central bank to guide policy going forward. So, what could we do instead? Well, to sustain a healthy democracy over time, I argue, requires ensuring the legitimate exercise of delegated political power, which does involve, as we've seen, outlining conditions for legitimate delegation and holding agents to account. But it further requires sustaining the effective power of the legislature over time. Effective power here is more than the formal or legal power. It includes needing an awareness of what one is responsible for governing, what might be different, and the disposition to actually deploy that power. To sustain this effective power over time, I argue, the legislature needs to exercise it. It's got to know and regularly show its power over monetary policy. And this is what I call iterative governance as a form of active management. So this sort of active management is in which the legislature engages in guiding policy is clearly distinct, of course, from holding the central bank to account. As one British MP put it when speaking to the governor of the Bank of England, quote, "All we can do is simply ask questions and listen to your very erudite explanations. What good is that sort of accountability to an elected politician?" Iterative governance is meant to solve this problem. It's a model of delegation that recognizes and capitalizes on the fact that the relationship between the delegator, the legislature, and the delegate, the central bank, takes place over time. It requires that the legislature engage in regularly steering monetary policy going forward. Consequently, it enables the legislature to sustain its effective power over monetary policy alongside a degree of administrative discretion. Because power is not exercised exclusively through the outline of guardrails or a mandate, under a model of iterative governance, discretion need not entail autonomy. This is, of course, good for the health of the democracy over time, but there's also good reason to think that an embrace of bureaucratic discretion could be desirable for other reasons as well. So for reasons of time, I'm not going to go into a lot of depth here on how I see this working in practice, but just to mention that in the book, I develop a few structural reforms that are meant to illustrate what the iterative governance of monetary policy in the US might look like, including suggestions for a system of annual credit guidance that would offer a mechanism for the legislature to offer operational input on monetary policy, and then also regularly recharting the Federal Reserve System, which would be an avenue for more institutional input from the legislature. So, just to observe that monetary policy as if democracy matters, on my account, must be political, because democracy is at base a political form of governance. A precondition then for monetary policy as if democracy matters is putting monetary policy in the political domain. Now, in light of that observation, it's worth noting two things. First, that to say something is political is not to say that it does or should have a particular politics. In other words, there's no intrinsic connection between what I've outlined here, monetary policy as if democracy matters, and any particular politics or partisan conception of how monetary policy should be deployed. Second, that to argue for an institutional arrangement that's required, in my view, to establish monetary policy as if democracy matters requires making monetary policy political and establishing firm, ongoing legislative power over monetary policy. This is, of course, importantly distinct to presidential power, which the framers of the US Constitution, of course, explicitly wanted to avoid, as they worried any such powers over money creation or allocation would make the president far too like a king. So to put it differently, democratic monetary policy must be political, but all political monetary policy is not necessarily democratic. Nevertheless, some might ask, and have, really? You want to give Congress more power over money creation? Well, this question tends to come in two phases, so I'll take them separately. The first is the more technical form, right? So it goes something like this. Haven't you heard of time and consistency and credible commitment and the electoral business cycle and Ulysses? And the answer to that is yes, I have. But for those of you who haven't, the classic defense of central bank independence involves these matters, and it goes something like this. Monetary policy suffers from time and consistency. which means that what is optimal policy in the short run and what's optimal in the long run don't line up. And this, in the case of monetary policy, is often described in the form of the electoral business cycle, right? So the idea is that politicians who want to get reelected will juice the economy in the short run leading up to the election so that they can get reelected. But in the long run, that's going to be terrible because it's going to cause really painful inflation. To avoid this problem and this problematic incentive structure, the politicians should delegate monetary policy to an independent central bank. Like Ulysses here, right, to avoid the temptation of bad policy, the legislature should tie itself to the mast of central bank independence. So, there's lots to say and critique about this. Don't get me started on the disanalogies between Ulysses and the legislature. But just to point out a few things, right, the first is that it's not clear to me on this view why monetary policy is really that different to other policy areas, right? So think about the case of taxes, military policy, the environment, immigration policy. There are short-term policies in all of these areas that might look really good before an election that would have bad long-term consequences, right? So tax cuts, for instance, cuts to environmental regulation, perhaps military intervention in some instances, huge deportations. You could tell a story about all of these things that make them look good right before an election for electoral outcomes, but would have bad long-term consequences, particularly for the economy. And furthermore, I think this picture, this model, this time and consistency model is pretty unfair to both voters and elected politicians, right? So it's worth pointing out, right, that voters and politicians as well also regularly factor in the long-term consequences of policy, and they're forced to by the electoral system. So think about this, right? Suppose someone's running for election and they say, I'm going to eliminate all taxes. Please vote for me, right? Like, that sounds very good, but it would also have very bad long-term consequences. What happens in that instance? Well, one, many voters will think that's actually a bad idea because of the long-term consequences. And two, other politicians will say, that's a bad idea because of the long-term consequences. So the model that is offered in this time inconsistency picture is just really very simplistic. And another way to see it is to think about central bank independence itself, right? So the central bank independence in this country is not constitutional. It's simply by virtue of a piece of legislation. So if the US Congress wanted to tomorrow, it could overturn it, right? But why doesn't it? Presumably because it has some sort of conception of the long-term consequences of doing that. So the model itself doesn't fit the picture that we see, because the Congress is not at all like Ulysses. It's not bound to the mast. It's more like it's sticking its fingers in its ears because it could undo its binds at any moment in time. So the second thing to say about the time and consistency defense of central bank independence is that we have to remember it's a relative question, right? It's not, is Congress time inconsistent? It's, is Congress time inconsistent, more time inconsistent than central bankers, and therefore should we have central bank independence? Well, central bankers suffer, and they'll admit this themselves, they do regularly, from time inconsistency as well, right? So one obvious example that's well recognized by central bankers in the literature is forward guidance, right? So they declare to the markets on a regular basis, we're planning on doing X, Y, and Z in the future. This is our plan. That opens them up to time inconsistency if when that moment comes around, that policy is no longer optimal. So secondly, I think perhaps even more striking is the example of something like corporate debt. And they, again, central bankers in speeches have themselves recognized the time inconsistency of certain bailouts of corporate debt markets that cause an extreme surge in corporate debt. And as a result, their policies later on become time inconsistent. So in sum, it's just not at all obvious to me that the argument that's traditionally offered in favor of central bank independence amounts to a decisive defense of the institution. But that leads to the second form of this question that I regularly get, which is a little bit less abstract, but no less forceful. And that is, really, you want to empower this particular Congress? And the first thing to say here is that I think there is some reason to believe that the state of the US Congress is not unrelated to the widespread delegation of meaningful political power out of the legislature and into the administrative state. So if we delegate the politics of making hard decisions and trade-offs to administrative agencies, we're actually enabling a certain type of performative politics that's increasingly meaningless, which encourages more delegation, because why would you want to give performative politicians more power, which enables more performance? It's a really quite a vicious cycle. But the second thing is just to say that if one is really truly committed to establishing monetary policy as if democracy matters, and perhaps you're not, you might be willing to say, I'm just really cool with undemocratic monetary policy. But if you are committed to democracy, then yes, you have to be willing to be ruled by people that you disagree with. That's the name of the game. So I'm just going to conclude with this thought about the idea that democracy is inherently risky. Political theorist and legal scholar Jeremy Waldron once wrote, quote, "The vulnerability of the powerful at the hands of the powerless does not come into existence by magic. It has to be constructed, and unless something is done to sustain it, it will not last." I argue in the book that democracy requires iteration, not only because people make mistakes and things change, although for those reasons too, but because iteration is required to maintain the effective power of the legislature over policy. Embracing truly iterative governance requires us to embrace a degree of risk. With that risk comes actual power and real responsibility, real politics in contrast to political performance. Empowering the legislature to steer the macroeconomy means empowering Congress to act as it sees fit. For those representing the interests of the financial sector, predicting, understanding, and influencing the legislature's decisions on monetary policy is likely to be considerably more difficult than predicting, understanding, or influencing the Federal Reserve. But for citizens qua citizens, this change should make it easier to influence monetary policy through elected officials, and that's exactly what makes it good for democracy. So while iterative governance might seem like a radical notion from the perspective of macroeconomics or central banking, from a different point of view, it's a proposal that is avowedly pro-politics and nonpartisan. Just like expanding suffrage, advocating for the political governance of monetary policy is to say nothing about which politics should be adopted. Quite the opposite. By sustaining legislative power through the regular exercise rather than the statutory explication, iterative governance explicitly embraces uncertainty. In attempting to institutionalize moments in the legislature in which they're required to decide if policymakers do things differently, it embeds a sense of palpable indeterminacy of the future. So embracing democratic governance, then, is clearly risky, particularly for those who benefit from the status quo. But that's always been true. Just as some worry that embracing universal suffrage would lead to poor policies, the primary argument against political governance of monetary policy is that it's going to produce bad economic results. Well, for some, that's clearly enough to reject it. The book outlines what it would look like to govern monetary policy as if democracy mattered. It doesn't offer a comprehensive argument in favor of doing so, but what is clear is that those who reject iterative governance in favor of central bank independence, even central bank dominance, must be willing to face up to the fact that in so doing, they are undermining the health of the democracy. And with that, I will end. Thank you very much for your attention. I appreciate it.
As ever, we have a couple of mics. Who wants to begin the conversation?
So, someone who will agree with you that power in the hands of unelected bureaucrats is problematic is, of course, Elon Musk. Mm-hmm. He hasn't gotten around to the central bank yet, mm-hmm. but he might be on the way there. Mm-hmm. Your last slide and your last point mm-hmm. Is what he's doing to other parts of the American government what you suggest should happen to the central bank also, or where does he get the analysis wrong?
Good question. No, it's not what I'm suggesting. Where does he get the analysis wrong is a hard question to answer, because I guess that easy answer is everywhere, in my view. I think something like the most sympathetic answer I could give is that something like the Department of Government Efficiency that is attempting, although I don't like the framing of efficiency, I don't feel compelled by that because I don't think it's obvious to me that there's so much fraud and abuse or whatever it is that he's obsessed with. However, a body that was going through the government and trying to figure out how to maintain effective legislative power and integrate the political governance of expertise would be something I would support, but it would obviously not be run by an unelected, like non-expert, right? It would be run by it would have to be the legislature that's involved in setting that up and figuring it out. I don't have a lot of sympathy for that approach, both because I think the sort of intellectual motivation of like, we need to cut costs and there's a lot of fraud and abuse is not backed up and isn't really sympathetic with my project. And two, because the way they're going about doing it seems pretty arbitrary and unguided by any sort of theoretical claims. I also think just it's worth pointing out that part of the argument in the book is that it's not that we should eliminate expertise in government, like quite the opposite. I think expertise is essential and the administrative state is essential. That's sort of what gives the state its power to actually do things, which is a huge part of my theory of democracy is the capacity of the state to do things. What's important is that we figure out how to employ expertise rather than becoming ruled by experts, right? Because it's not even so much that the rule is the issue. I mean, that is, but it's also that in jettisoning so much political power to an administrative state, you're also undermining both the responsibility and the power of the legislature itself to do stuff. And that's really the key democratic issue, in my view. I shouldn't have had bubbly water. That was a real mistake. Thank you.
Next up.
Thank you very much for this talk. Really provocative and eye-opening. I'll show my colors. I teach a class called Financial Institutions here, in which I'm an evangelist for central bank independence. So
Good.
This has certainly raised some great questions. I recognize and agree that actually the Fed has a problem. And a recent poll that was published in the FT shows that more than 50% of people don't trust the Fed. And also, a majority of Republicans think that the Fed is controlled by Democrats, and a majority of Democrats think the Fed is controlled by Republicans. So there's a real education and communication problem here, which I think the Fed does need to address and seeks to do so through an extensive public calendar. My concern, and I really like the way you framed this, is that if we put more monetary policy in the hands of the legislature, it will lean expansionary. And so how would you counter criticisms that, for example, the last FOMC meeting, as a result of control of both houses and a president banging the table, that the Fed wouldn't lower rates at a time when we're likely to have more inflation?
Interesting question. I mean, I think the more theoretical claim, right, that it will tend to lean expansionary if it was under more control of the legislature. I have two responses to that. One is I feel skeptical of that as like a blanket claim, right? Because historically, we had more political control over monetary policy, and there were expansionary episodes, but it wasn't like the moment they get their hands on it, things go crazy. So just historically, I'm not sure the evidence totally backs up that as a uncaveated claim. And second, and related to that goes back to this time and consistency argument, right? And the claim that like, well, if that happens, like, you know, if there's an expansionary issue and then surely there's that, like, this is what democratic politics has been done for thousands and thousands of years. Then there's a correction, right? Like, and sometimes an overcorrection, but that's how sort of party politics works. So I'm not sure that would just be universally true is the first thing to say. The second thing to say was quite interesting question of like about the specific policy choice to raise and lower rates. I don't know what they would have done specifically in that instance, but what I'm suggesting here is not that Congress should be voting on every interest rate rise and lower, right? It's a form of guidance. So they have the opportunity and the requirement to vote annually on sort of steering credit and then more regularly on revising and the whole institution of the central bank. And you could make an argument in this vein for iterative governance in which the central bank should actually be voting on interest rates on a regular basis. I don't think that's required to get the picture that I'm showing here. And this goes back to my previous answer of like, I don't think we should be eliminating experts and expertise. I think we just need to put them into the power hierarchy in their proper place, right? Which is not on top. And I also think that it is true that you would get a different type of, like, you're not going to institute this, I don't think, and then continue to have the same type of monetary policy that we've had for the last 25 years. Like, things would change, but partly that's because it would be more in service of a democratically articulated public vision of what monetary policy should look like, which might not necessarily be that which would underpin the sort of effectiveness of the private financial industry at all times. Sometimes that would align, but not always, I would think. So.
Next up. Good, two next to each other. You can share this one. There you go.
Hi. In Citizens United, the Supreme Court gave even more clout to corporations. Mm-hmm. Do you think that in a more democratically oriented monetary system, it would be opening the door for corporations to nudge further in?
Yeah, great question. So in the book, I focus on this second moment of delegation, as I put it. But I spend quite a lot of time talking about how if we're figuring out how to create an arrangement in which sort of democracy is healthy over time, of course, that first link in the chain, right, from the people to the legislature is hugely important, right? And to me, that's where this question sits, right? So things like gerrymandering and Citizens United, right? So like financial electoral policy are about the connection between the citizens and the legislature. And that has to be right. And I don't think it is at the moment in the US. And so the harder version of your question would be, okay, supposing that's not right, like a world we are in now, does making the connection between the legislature and the administrative state more along the lines that I am suggesting, would that actually exacerbate the problem rather than correcting it? And I think it's a tricky question. I mean, the truth is it's like an empirical question that I don't have a clear answer to. I would still advocate doing it, I think, is probably my answer. But it's a very good question. And it's sort of, do you send the cart first or the horse first, or which is the cart and which is the horse? I don't know. Thank you.
Well, quick follow-up question to that would be, why would you still advocate doing it? Mm-hmm. And thank you for a fabulous talk. I was just hoping that you could talk a little bit more about the other arms alongside the central bank here, like the role that the IMF and credit rating agencies play as well. Mm-hmm.
Great question. Wow. So there's a lot of ways to go about that. So just briefly on credit rating agencies, there are some proposals. So one of the things that I argue in the book that this form of iterative governance would offer would be dedicated moments in the legislature to discussing things like potential reforms to the financial system, right? So right now, for instance, the Fed chair's testimony in front of Congress, if you watch it, is like a really bizarre exercise because most of the time it's questions that are somewhat like, why did you not do X or why did you do Y? And the Fed says, well, we did Y because we thought it was the best thing to do in order to fulfill our mandate. And here's why, explanation, blah, blah, blah. But sometimes it's legislators saying things like, well, do you think that it's a good idea for us to completely reform the central bank in X, Y, and Z way? Or how would you react if we decided to do things differently? And it's this kind of strange Frankenstein of the legislature asking the Fed if the Fed thinks that they should be completely reformed and in what way, because there's this kind of lack of space for the legislature to have that conversation properly. So in rechartering the Fed, I would hoping to be open space for that. And one of the things I do in the book is list some of the examples of things that you might see in that discussion that are bubbling around in the world right now. One is a discussion of credit rating agencies, right? So like, what is the role? Should there be a public option for credit rating agencies? Should they be more heavily regulated? Should there be more of them? This type of thing. And I think they're an essential piece of the picture of how credit and democracy interact in our world. And so I think that would be an important discussion for the legislature to be engaged in. To your question about the IMF, the international picture is a big piece of the book. It's like the whole last third, and it's a tricky one, and it's quite interesting because essentially what I say there is that if you are really committed to a form of democracy or a form of monetary policy that sort of underpins the health of the democracy over time, and here we're talking about democracy at the level of the nation state, then you do have to draw the lines more clearly, right, between the boundaries of where your policy applies. And that would involve more sort of domestically driven monetary policy and regulatory policy. And that would definitely undermine the existing, what I call global governance network of the international financial system, including things like the IMF, but more stuff like the BIS and that sort of thing. So it would absolutely, the international ramifications of the domestic suggestions that I have would be massive. It would totally undermine, because if you just think about it, right now, the international financial world doesn't have to really take domestic politics always as seriously, and this would change that. I think I've answered your question. Have I answered your question? Okay.
Next up. Just keep it here for the swaps question.
Thank you so much. Really provocative and fun talk, and I'm convinced I need to skim or even read the whole book. I'm curious, it brings to mind Chevron doctrine, and
Yes.
that may be coming to an end, but
Yeah.
why isn't this just okay under the fact, that sort of long precedent of legal decisions and review?
Yeah. The Chevron doctrine plays quite a role in the book. So, how to best get into this answer? Okay, so the Chevron doctrine, of course, talks about delegation from the legislature. For those of you who don't know, from delegation from the legislature to the administrative state. And historically, there has been a deference to administrative agencies as long as the way that they interpret their sort of legal mandate or what the legal sort of language that they're acting off of reasonably. And my view on that is I don't really have a lot to say about if that's right or not. I do have a lot to say about that. I don't want to say if I think that's right or not, because what I want to focus on is this forward-looking element, right? So to me, the Chevron doctrine is the courts engaging in some degree of judging compliance, right? So have you complied with the legislature's conditions for action? And that's fine. And I don't want to comment on the best way to do that, because what I'm more concerned about is, regardless of how you think that should work, let's say it works exactly how you think it should, we're still missing a piece in a healthy democracy. And that's the power of the legislature to guide these institutions effectively going forward, not just in terms of compliance and legitimacy in a backward-looking sense. Yeah, go ahead.
Yeah, I mean, I want to two-finger on that, which is to say that would complicate substantially the role of the courts, because you take an organization like the EPA, and they're getting now annual guidance about what the decision should look like. They make a decision, and then the courts X amount of time later have to rule on it. I mean, it seems to be...
No, but I guess what I'm trying to say is I'm not taking a view on the courts, like the way that they should be interpreting that. Like, continue as is, if you like, right? So like whatever your view is of the Chevron doctrine and the role of the courts in deciding the legal exercise of administrative discretion, you can have that. But that's insufficient to the picture that I'm drawing here.
And all I'm saying is that the legislative intent that the courts are ruling on is going to be subject to constant fluctuation with this kind of...
Oh, I see, with the active management. I see what you're saying. Yeah. I actually, in my picture, you would have less of that in theory. I mean, I am not a legal expert, so I can't say that. But in theoretically, the democratic picture is you would have less of that because it's more active management. So you would be enabling more discretion and by arranging the power dynamics such that you would be having this constant interaction and guidance, what you would be taking the sting out of, or the stakes out of, the interpretation of the mandate, because that's not your only mechanism for legal or for legislative legitimacy. At least that's the argument.
I guess I've been prompted.
Yes.
So coming back to the question of the international jurisdiction, how would you characterize drawing those lines when banking systems are so interconnected, and what happens abroad, whether it's just foreign banks or subsidiaries and branches, affects the US? And the second point is, if monetary policy and central bank policy in general become domestically driven in this iterative democratic perspective, what does the global monetary hegemon do in times of crisis?
Great. So in terms of how you would draw the lines, I mean, do you mean like mechanistically or? Okay. It would be, there's some arguments for it in the book. I follow here really strongly like Morgan Ricks's work on international like financial stuff, and I love his phrase, like, to confine, you have to define. So there'd be a lot of work to do in terms of like just defining who's acting as a bank and how they should be regulated as such, in particular as regards the Eurodollar market. And there's no precedent for that, right? So there used to be specific Eurodollar reserve requirements at the Fed that have just been not used for a really long time. So we could get back on that game. And I think part of the suggestion in the book is that also that the Eurodollar market has ballooned to the extent that it has. This is like a reinforcing cycle, of course, right? Well, you know this better than anyone, but it's ballooned to that size partly because of the implicit underpinning of the Federal Reserve. So if you're going to say, actually, we're going to be making this domestic picture very different, then presumably also that's going to naturally shrink the size of that market. On your second question, implicitly about swap lines. Here, I think that, there's two things to be said here. The first is that obviously doing what I'm suggesting here would entail some more direct form of political governance over exactly things like swap lines, right? So that could massively change the dynamics there. In terms of who gets a swap line and why they get a swap line, right? Because the domestic politics is going to come more into that picture. Is that better or worse, and for whom, is an interesting question. I think you have to, again, remember that this is a relative question. Like, do we want that question to be asked and answered by the US Congress, or do we want it to be asked and answered by the FOMC or the BOG, right? And it's not obvious to me that the second is actually a better system. Or would have better outcomes depending on lots of contingencies. And so for me, the view is if that's not obvious, and B, it is clear that the former is better for the health of the democracy over time, then it's an option that needs to be really taken pretty seriously. Furthermore, part of the thing that I talk about in the last section of the book is that there's a lot, this literature, as I say, better than anyone, there's a huge amount of discussion about like, what is the best way to govern the international financial system? It's clearly not, well, most people would say it's clearly not what's happening now. Then there's proposals for things like Bretton Woods 3. When's that going to happen? And then there's proposals of things like, well, we should just isolationism for sure all the way. And what I think that I'm coming at it this way from the domestic would say is like, it open up a space of discussion, right? Because if we pull back into the domestic sphere a little bit and the democratic, and then you have a conversation about, does the US doing that have a domino effect where other states have to sort of reconsider then, because the US is the hegemon, what are we going to do, right? Are we going to sort of offer a different system? Should we have an international system that's actually more explicitly politically run as opposed to the current sort of shady one? Or is it more sort of domestically driven? But anyway, hopefully the idea would be that it would open up that discussion a little bit more explicitly.
All the way down. Yeah, we're going.
Thank you so much. This is a bit of a tangent. So what about judicial independence? Because court rulings are influential, like central bank policy. You cite Jeremy Waldron. He doesn't think judicial review should exist. And Mexico is electing its judges now. Should other countries follow suit in the name of democracy?
We do.
Yeah. Okay. Yeah.
It's a good question. I often get this question. I think there's two ways of answering it. One would be to give my whole shtick on what I actually think about judicial independence and review in particular and Waldron's arguments. But I think the more succinct answer and the truer answer is that it is a fundamentally different thing because that's a constitutional independence. Right? So that is clearly different to Fed independence in the sense of it just being a legislative decision. This goes back to the Ulysses picture of like, judicial independence is much more akin to tying oneself to the mast than Fed independence is. That's the first thing to say. The second difference is, of course, it's true that it is not a clear distinction between agencies in the administrative state, including if you include courts in this, that are sort of meant to make policy or make regulation and interpret or apply, right? That distinction is completely blurry. However, I do think it is a principled distinction, right? It's not at all the case that the Fed is meant to just merely interpret or apply. It is creating policy all the time. And that to me is fundamentally different. And it's a legislative power, essentially, that it's been delegated. And so it needs to be more tightly controlled by the legislature.
Any other?
Thank you. This was a really interesting talk, and now I have a new book to read. You mentioned at the start that, this is very much an American politics kind of story. But I am curious how this moves at all, if at all, to other contexts, because I think the point you make about the U.S. being the hegemon in the current global financial system does put them in a really unique position if they wanted to go out on a limb like this. Yeah. That I'm worried that other democracies actually don't really have that sort of flexibility when the IFIs are still very much banging the drum about central bank independence being the only way to build a robust economy. So I'm just curious, how much have you thought about that? Where's your head at on that right now?
Yeah, great. It's a great question. So what I meant at the top, and I think there's sort of two answers. Like, one is the theoretical answer, right? So central bank independence is obviously widespread around the world, partly for some of these reasons, right? And so the theory that I offer about the relation, like the place an independent central bank sits in a democracy, can be taken and adapted to lots of different jurisdictions. And the most complicated one, perhaps, and very interesting, is the ECB, for instance. So that, I think, is true, and it travels. In terms of practicalities of implementing this, I talk about it a bit in the third portion of the book, but your question almost hinted in the direction that I go, which is to say, if you were to see this happening, the most effective form of implementation would be a kind of cascade down the monetary hierarchy, right? Like, because if you, as you say, if you don't have the U.S. going first, it's going to be a heck of a lot harder for, Eritrea to do it. So that's there is a picture of sort of the way in which it would be implemented most effectively. Yeah. I believe that we are closed. Thank you, everyone.